Welcome to Macro Money Talk, where we unravel the complex financial systems that silently control the flow of wealth in our world. Have you ever wondered why some people access capital almost for free, while others pay exorbitant fees just to survive the month? This phenomenon is defined by the concept of cheap money, a privilege that is not distributed equally among the population today. Cheap money is not simply about low rates. It is a trifecta of low interest, long repayment terms, and solid collateral. It acts as an exclusive club membership, granting specific advantages to a select group while keeping the majority locked outside the gates. When money is cheap, it flows like water to those who already have reservoirs, filling their pools with minimal effort or risk. The defining characteristic of this privilege is time. Cheap money allows you to think in decades rather than worrying about next week. Imagine borrowing $1 million but having 30 years to pay it back, with inflation slowly eating away the debt's real value. This stability stands in stark contrast to the volatile reality of expensive money, which is the only option for the asset poor. To understand the global economy, we must first distinguish clearly between these two types of capital and who gets access to them. Cheap money manifests primarily as mortgages or secured business loans. It is flexible, forgiving, and designed to support long-term asset growth. For corporations, it means accessing funds to build factories or buy competitors, knowing the debt can be refinanced if trouble arises. In the financial markets, it appears as margin debt, allowing investors to amplify their returns using money that costs very little. On the other side lies expensive money. This is the realm of credit cards, payday loans, and unsecured consumer overdrafts. Here, the interest rates are double digits. The system demands immediate repayment, creating a high-pressure environment with absolutely no safety net. Expensive money is unforgiving. If you miss a payment, the penalties compound quickly, trapping you in a cycle of deepening debt. While cheap money offers flexibility and renegotiation, expensive money is rigid. It creates a trap that is incredibly difficult to escape. Access to these two worlds is structured like a pyramid. Your position on this pyramid dictates the price you pay for money. At the very pinnacle sits the government. They enjoy the lowest possible risk because they control the rules of the game. Governments have the unique power to tax citizens and print currency, making their default risk theoretically zero in their own currency. Because of this power, they borrow at the lowest rates, setting the baseline for the entire global financial economic structure. They do not need collateral because their promise to pay is backed by the entire economic output of the nation itself. Just below the government are the major banks and multinational corporations. These entities are considered too big to fail by regulators. Their risk is distributed across the entire system. If they stumble, the government often steps in to prevent a total collapse. This implicit guarantee allows them to borrow billions at rates only slightly higher than the government, fueling their massive global expansion. They use this cheap capital to build infrastructure, acquire smaller competitors, and dominate markets, reinforcing their position at the top. The system protects them because their failure would cause catastrophic damage to the economy, granting them a permanent safety net. Next in line are the asset owners. These are individuals who hold significant real estate, stocks, or profitable private businesses. For banks, these assets are the key. They are tangible, measurable, and can be sold to recover funds if necessary. Because they offer collateral, the bank's risk is minimized. This allows asset owners to access mortgages and loans at low rates. They can leverage their existing wealth to acquire even more assets, creating a compounding cycle of growth powered by cheap debt. Below asset owners are the high-income professionals, doctors, lawyers, and executives who may not have huge assets yet, but have stability. Their income is predictable and high. Banks trust their future earning potential, granting them access to reasonably priced credit and loans. While they lack the hard collateral of the wealthy, their human capital and creditworthiness serve as a strong substitute for security. Finally, we reach the bottom of the pyramid. This group includes those with unstable incomes, no assets, and no safety net. For this group, the door to cheap money is firmly locked. They are considered high risk by the algorithmic banking models. They are forced into the arms of expensive moneylenders. Credit cards and overdrafts become their only lifeline during emergencies. Without assets to pledge as collateral, they pay a premium for every dollar they borrow, trapping them in poverty. Why does the system operate this way? It is not about malice. It is about the cold, hard logic of risk management. The financial system does not care about your hard work, your dreams, or your character. It only cares about recovering its capital. Collateral reduces uncertainty. When you pledge a house, the bank knows it cannot lose, so it charges you less. When there is no collateral, the uncertainty is high. The bank charges a premium to ensure against the high probability of default. This creates a paradox, where those who need money the most pay the most, while those who have money pay the least. Let's look at the strategic benefits of cheap money. It allows the wealthy to survive crises without selling their precious assets. When a recession hits, they can borrow against their assets to pay bills, waiting out the storm until the economy recovers. Conversely, those relying on expensive money are often forced to sell what little they have at rock-bottom prices just to survive. Another major advantage is the inflation hedge. Cheap debt usually has a fixed rate, but the asset value rises with inflation. Over 10 years, the real value of the debt decreases, while the price of the real estate or stock portfolio likely doubles. This creates a wealth transfer from savers to borrowers. The borrower wins by simply holding the asset and waiting for time to pass. Cheap money enables long-term strategic thinking. You can invest in education, business expansion, or R&D without the pressure of immediate returns. Expensive money forces short-term survival. You are constantly putting out fires, unable to plan for next year because next week is uncertain. This dynamic acts as an elevator for the wealthy, lifting them effortlessly to higher levels of prosperity with minimal physical exertion. It creates an invisible wall in society, separating those who work for money from those who make money work for them. Understanding this is crucial. It is not enough to just save. You must position yourself to access the tier of cheap money. The goal of financial literacy is to climb this pyramid, to move from being a high-risk borrower to a secured asset owner. Once you cross the threshold into the world of cheap money, the power of compound interest begins to work in your favor. This journey requires discipline, understanding credit, and accumulating the first layer of assets that will serve as your future collateral. The system is designed this way, and while it may seem unfair, knowing the rules is the only way to win the game. We hope this breakdown has clarified the invisible mechanics of cheap versus expensive money and how they shape our economic reality. If you found value in this video, please like and subscribe. It helps us continue to bring you these financial insights. Remember the 3 takeaways. Know where you stand in the hierarchy, build collateral, and use debt strategically, not just for consumption. Financial freedom is a climb. It is difficult at the bottom, but the view and the opportunities improve with every step up. Stop seeing money as just currency. Start seeing it as a tool, a system of leverage that you can learn to master. Don't let the system use you. Learn how the system works so you can use it to build a secure future. True wealth is not just about having cash. It is about having the peace of mind that comes with financial control and access. Make your next move count. Build your assets, protect your credit, and unlock the door to the world of cheap money. Thank you for watching this deep dive into financial mechanics. This is Macro Money Talk. Subscribe for more insights. Goodbye. As a final thought, consider that cash loses value every day. Debt fixed in nominal terms is actually a short on currency. Holding cash is risky in the long run. Holding productive assets financed by cheap debt is the historical path to great wealth. Educate yourself on the difference between good debt, which puts money in your pocket, and bad debt, which takes it out. Buying a luxury car on high-interest credit is bad debt. It loses value immediately and costs you money every single month. Buying a rental property with a low-interest mortgage is good debt. The tenant pays the debt, and you keep the equity. Every financial decision you make sends you down one of these 2 paths. Choose the path of accumulation, not just consumption. Start small. Your first asset might be small, but it is the foundation. Don't despise the days of small beginnings. Like a tree, wealth takes time to grow. Cheap money is the water and sunlight that accelerates this natural growth process. The economy is vast and complex, but the principles of leverage and collateral are universal constants that have existed for centuries. From the merchants of Venice to the bankers of Wall Street, the rule remains: those with collateral set the terms. Use this knowledge as your compass. Navigate away from the storms of consumer debt and towards the haven of asset ownership. We believe that financial literacy is a human right. Everyone deserves to understand how the money in their pocket truly works. Share this video with someone who needs to hear this. Help us build a community of financially literate and independent individuals. We want to hear from you. Have you experienced the trap of expensive money or the benefits of cheap money? Comment below. Your stories help others learn. Let's create a conversation that moves everyone forward towards better financial health and stability. This is Macro Money Talk. We are dedicated to decoding the macroeconomy so you can improve your microeconomy. Imagine a future where you are no longer stressed about money. That future is possible with the right knowledge and actions. Take the first step today. Review your debts. Check your assets. Make a plan to move up the pyramid of capital. Time is your most valuable asset. Don't waste it paying interest on things that don't matter. Invest in your freedom. Transform your labor into capital. That is the ultimate secret of the wealthy. Stop working for money. Make money work. From this high altitude, the game becomes clear. It is a game of accumulation, leverage, and patience. Play it wisely. Let the numbers guide you. Emotions are the enemy of investing. Logic and math are your best friends in finance. You don't have to fight the system. You just need to understand how to partner with it for your own benefit. The door to cheap money is heavy, but it is not locked forever. You hold the key in your own hands. Government, banks, asset owners, professionals, and the rest. Know your level and relentlessly climb to the next one up. We believe in your ability to change your financial destiny. It starts with a mindset shift and ends with action. Keep learning. The landscape of money changes, but the fundamental principles of risk and reward remain forever the same. Let us be your lighthouse in the foggy world of finance. We are here to guide you to safe harbors. Don't forget to subscribe and hit the notification bell. You won't want to miss our next deep dive video. Thank you for spending your valuable time with us. We appreciate your support and your hunger for financial knowledge. Until next time, keep analyzing, keep learning, and keep growing your wealth. This is Macro Money Talk. Goodbye for now.